With everyone focused on the broad market and the Mag 7 for signs of a potential bubble bursting, my guest today, Matthew Piepenburg, argues that the bond market is where the real danger lies. And with gold surpassing U.S. Treasuries as the largest reserve asset globally, the sell Treasuries, buy gold trade could spell major trouble for credit markets around the world. Matthew outlines what could happen in the aftermath, why he thinks silver is likely headed to $300 an ounce, and you're going to want to stick around to the end of the interview where Matthew discusses how we can all protect ourselves from rising geopolitical instability, conflicts flaring up around the globe, and an economic environment that could be more inflationary than expected up ahead. All of that right now. Matthew Piepenburg, it is great to have you back on Commodity Culture. Now, Friday last week, we saw a mass sell-off event in markets with the NASDAQ falling nearly 5% and much greater losses across precious metals and commodities equities. Yesterday, markets recovered somewhat, but still fairly muted. I'm wondering what you make of this recent price action. Obviously, one day's worth of data is not enough to make any sort of conclusion, but do you think things are starting to crack in the broad market? And assuming we do see this sort of price action continue and potentially see a real bear market emerge, what would that mean for gold, silver, and the commodities complex?
Yeah, Jesse, again, thanks for having me on. These are all important questions that are on all of our minds. I think things are very much starting to crack or snap, as I've written recently, and we can talk about it. I think one of the first things I'm just looking at, we're all kind of feeling and seeing, is this incredibly embarrassing disconnect between the real economy and the markets, and the S&P in particular. Here in Europe, but in the United States where I'm from, there's a fantastic sentiment indicator from the University of Michigan, and it started in the early 70s, and it's been tracking kind of the Main Street zeitgeist for decades. And it just reached recently its lowest sentiment reading in its 5-decade history. And what's interesting about this isn't just a tracking of sentiment, but whenever these sentiment levels reached this low, and in this case, the lowest in history, it was always, every time, followed by a recession on Main Street. So these are kind of the economic risks, along with the currency risks and the banking risks and the geopolitical risks, and of course the market risks, which, Von Greyer's entire model of gold storage outside of these fractured systems is based upon. But when I look at the broader markets right now and where it's heading with the gold price and the gold direction, which is extremely bullish for me, of course, I'll explain why, but the bond market is the broad market. It is the basis of all markets. I can't say it enough. The bond market is the thing. I know it kind of creates eye rolls. It's kind of boring, but it's actually globally a $145 trillion global market, which is 20 trillion bigger than the global stock market. And most importantly, bonds represent debt, and their yields represent the cost of debt. So bonds are the wind beneath the wings of the S&P and this bond market. And that bond market is snapping. And I think the proof of that is in the fact that sovereign bond demand is tanking. And we see that with the yields on government IOUs, or government sovereign bonds, the 10 years out of the UK gilt, the US Treasury, the German Bund, the Japanese JGB. It's the same in Italy, France, Canada, they're the highest yields in decades. And this is because trust in these sovereign IOUs is the lowest in decades. And it's not just me saying this to be sensational. Even Bloomberg, their 5-year annualized return in aggregate global bonds was the lowest on record. So it is a bond crisis. And what does this mean for the markets and therefore for gold? Well, again, rising yields equal rising debt costs. And this is in a market driven by liquidity from debt, but the cost of that liquidity is spiking. And again, this affects every asset class. In the markets, it certainly affects stock buybacks, which are driven by cheap debt. And when the cheap debt becomes higher, that affects the markets. CapEx is driven by cheap debt to be successful. That's affected. I've written for the last couple of years about the warning signs in both private equity and private credit markets, because they are also driven by cheap debt and start to cough and choke when those yields and debt costs rise. So I think those are very, very real needles pointed at this very overvalued by every metric stock market. But even the global derivatives market, Jess, it's 10 times the size of the pre-08 derivatives disaster, and it's 4 times the size of all global assets. That too is driven by low rates. So when rates get higher, deleveraging starts. That puts risk in a very risky and often ignored derivatives market. But our government is also driven by cheap debt. So we're seeing a real liquidity crisis. Many people have forgotten, even at the end of last year, the New York Fed Reserve Bank was giving massive cash infusions right around Halloween. 50 billion was infused into one of the banks. And then another 100 billion came in less than 2 months of daily cash infusions. And by the end of the year, the New York Fed Bank was removing the limits on cash infusions. About 240 billion in a single day went to like JP Morgan or HSBC and Wells and B of A, et cetera. So there's risk even in the financial sectors because of this bond market, which signals a liquidity crisis, which signals a massive crisis in the markets. And I think, you got to ask yourself, why is Berkshire Hathaway 400 billion in cash? They're all tied, ironically, the stocks and the equities are tied to what's happening in the boring, yielding, high-yielding bond market. And what this means for gold, which is obviously the thing that I look at the most, well, of course, most know in a bear market, traditionally, when stocks fall, bonds were the safe haven. And traditionally, when stocks fall, gold is sympathetic, as it was in 2008. We saw a 30% correction in gold before it ripped back up. Those are traditionally, but just traditionally, we were never 39 trillion in public debt. And I think bonds are no longer the safe haven. And what we saw, if people think back just as recently as March of 2020, before unlimited QE, stocks and bonds fell together. And during the higher for longer kind of crisis under Powell in 2022, we saw the worst nominal returns in stocks and bonds since 1871 in the US. And more recently on Liberation Day last April, when the tariffs were announced, the first day of the announcement, well, stocks and bonds fell. There was no bid in the bond market. So stocks and bonds are no longer yin and yang, they're correlated. That's a very important signal. And what we're seeing now in the bond market means former buyers are now sellers. The most obvious examples of this, again, in the bond market is China at its peak had over 1.3 trillion in US treasuries. Now it's about 650 billion. And Japan, which was the largest holder and is the largest holder of US treasuries, sold more US treasuries in the first quarter of this year than in the last 4 years because they all needed liquidity to support their currencies. So going forward with gold, the key issue in my conversations, gold could continue to sell off in a bear market to cover margin calls or other things, often needed liquidity. We see that over and over. You sell your most liquid and best asset to pay for the sins of your other assets. And that may or may not happen. I think there's going to be more of a move now, we can get into it later, why gold is more favored than US treasuries. But where gold goes secular in the next moment is very clear. Because we've never had a debt crisis and a bond crisis, and therefore a liquidity crisis of this magnitude. Never. Nothing like pre-08, nothing like the pre-dot-com era, nothing like 87. There's nothing to compare. So whatever moment, whatever needle from private equity to private credit to rising yields pops this market balloon, I think the direction is going to be less to US treasuries or bonds as a safe haven and more to better stores of value like gold. But, I'll close with this. Market up or down, I think gold wins. People will say that's, of course, the Von Greyer's team selling their book or Piepenburg selling the book. But if this market mean reverts, I don't think the world's going to rush again to U.S. treasuries issued by an issuer that's 39 trillion in debt and weaponized that U.S. treasury 3 or 4 years ago. So I think we're in a major, major turning point. But even if the market goes up and it doesn't pop because it's supported by massive liquidity from the expansion of the M0 or M2 money supply, you could technically make this stock market immortal, but only at the expense of debasing the currency in a very hyperinflationary or high inflationary setting, which is also good for gold. So I can be agnostic whether we save this pathetically bloated, overvalued market or whether it mean reverts. In either case, we're looking at inflation as the end game, and we're looking at debasement trade as the end game, and we're looking at gold going secular higher. And that can be ignored right now on these retracements. But from the bond market to the stock market to hard assets to gold, it's all connected.
The sponsor of today's episode is ARK Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arksgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now, back to the interview. Would you expect silver to respond the same way as gold in that sort of bubble bursting in the broad market scenario? Or is that a more uncertain path potentially for that metal, given that central banks are not accumulating it? It has not surpassed U.S. Treasuries as a reserve asset, and so much of its value, depending on who you talk to, is based on its industrial demand.
I mean, gold and silver are monetary metals, and I think in a monetary crisis, they're both going to have tailwinds. But you're right, central banks aren't stacking silver like they're stacking gold as a store of value or basically the de facto reserve asset. I think for silver, it's a little bit different, I think, in the sense that I think there's things that I looked at silver and I still think matters. Silver has got technical and basic supply and demand forces, but I don't think it acts quite the same as a monetary reserve asset as gold. And I think the buying opportunities in silver, we should talk about, I think that's important, really depend on your individual time horizon and profile. I mean, I see silver well over $300 coming very quickly. So whether I buy silver at 70, 90, 100, or 60 is not terribly important if I'm a longer term player in the space. When you and I were both in Vancouver earlier in January this year, when Rick Rule was announcing he was going to sell his silver before it's top. Well, why are you selling before it's top? But if Rick bought at 10, 17, 50, or even 45 silver, does it really matter whether he didn't wait till 120? In other words, what is enough for each of us and why are we investing in it? Now, I'm an investor in silver, not a trader. And I look at the ratios for the entry and ratios for an exit. But even when I exit, usually when I'm looking at a ratio of at least 30 into the high teens, gold-silver ratio, I'm just going to use it to buy gold, which will be undervalued at that compression. Because I'm looking at these metals as monetary metals. But to your point, there are fundamental forces of supply and demand outside of just the monetary system, in the industrial, in the military, in the energy sector, which require silver. And those demands are higher now than ever in a conflict-ridden backdrop that we're sitting in. But, I think with silver, you got to look at supply and demand. I still think that matters. We all know that we've seen 5 or 6 now consecutive years of 200 million ounce silver supply deficits. That's not just something to memorize. It's something you got to think about. That's over $1 billion and 1 billion ounces in supply deficits. So, and we look at the COMEX, the registered or available silver versus the open interest or the demand for silver. The ratios are off the charts. I think we're heading towards a cash settlement only COMEX. I've said that as far back as January. And if you look at the lease rates on silver, my entire career was rarely above 1%. Now we're well over 8%. So these are supply and demand forces that are really important, Jess. And I think the military industrial demand, remember, silver is a byproduct mined metal. You can't just create supply with the push of a button. And, solar panels, electric vehicles, military, that's even more demand now than reported. So this massive supply deficit at a time when silver is now on the critical minerals list as of last year, in a war where silver is an element for these weapons and EV adoption is rising and solar has more installs, it makes for an even stronger bull case on supply and demand. And I'll end with this because I think it's important on the technical side, and I'm not a trader, but of course I want to look at the direction or the signals. The last time we've seen something like this has been a while, but I see a bullish rather than bear case in silver when it dips beneath its 200-day moving average. I know that sounds kind of wonky, but it's very easy to track. This 200-day moving average is a massive signal for me. And again, I'm not even a trader anymore, but it's in my DNA to look at it. And the last time silver fell below this average was in April of 2025. And that was just before the metal, which was then trading at 27, ripped north by more than 26, by over 200%. Historical multiples, historical new highs. And prior to 2025, we saw a similar bullish signal when silver tipped below the 200-day moving line. That was in 2020 when silver was around $10 or $11, and then it ripped. And in 2022, the same thing. It touched that moving day average line when silver was at 17, and then continued to go north. So I think the technicals and the supply and demand fundamentals are massively important signals for the metal, for silver. By the way, that same 200-day moving average indicator where it dips below and then rips is actually the same thing in gold right now. So both metals at a technical level are positioned very well despite the retracements. But again, it's about your profile. Are you investing as a trader? Are you looking to leverage long and short? Are you looking to arbitrage? Or do you see these metals as monetary solutions to openly dying fiat money? I look at them both. Silver will have a better beta trade to gold when gold hits another bull market run, which it will, and we can talk about why. But yeah, I'm very bullish on both. Of course, people are going to say that's selling your book. But again, if you're a longer term investor, you can afford to be the most important thing of all when you're investing. That's patience. And patience comes from conviction. And the conviction comes from understanding the debt crisis and the debasement trade to monetize that debt. It's really a fat pitch to me. And, I'll keep saying this because we haven't gotten started on the bull market yet in gold. And so silver will track it, but for different reasons.
Yeah, some great thoughts there. And I do think that the long-term vision is most important. Unfortunately, for a lot of people, we now live in a world where social media is prevalent and where people have access to all sorts of tools online, which is actually great, but it can also be a curse in that people are watching day-to-day price action and they're getting caught up emotionally in that. Then they log into X and somebody says silver's collapsing and it's all over. And then they buy into that narrative. So I think it's really important more than ever in today's world to stay focused on the long-term vision. I want to talk about gold surpassing U.S. Treasuries as the largest reserve asset globally. This was actually reported late last year. A new report released by the ECB has kind of brought this back into the spotlight. Do you expect gold surpassing treasuries as a trend that will accelerate? And right now, I believe as we speak, 20 and 30-year treasuries are currently yielding over 5%, or at least very close to that mark. Could the sell T-bills and buy gold trade threaten the stability of the U.S. government bond market?
Well, I love that question because it ties back to the bond market, which I still think is everything, from which you can look at every asset class, including precious metals. The sell treasuries buy gold trade is already threatening the U.S. and its bond market. And really, this is, since 2022, when the U.S. dollar was weaponized, that was a watershed moment. I think one of the most important moments in the 21st century for the dollar. And right after that dollar was weaponized, already an over-indebted U.S. dollar and over-indebted U.S. Treasuries, then a weaponized U.S. Treasury, the de-dollarization meme became a growing reality, not just a meme. And many of us, including myself from day one, warned that this was a watershed moment. We saw 40-plus nations trading outside of the U.S. dollar. We saw Russian finance ministers like Kobayakov and Glassiev openly telegraphing and then later employing gold as a net settlement asset and collateral for global trade outside of the U.S. dollar and outside of the U.S. Treasury. And we saw almost 40 countries openly repatriating physical gold within their own borders. They were focusing on gold, not the U.S. Treasury. We've also seen, I've written about this for a year since 2022, it's culminating now, is the cracks in the petrodollar, which are critical buyers of sponges for U.S. Treasuries and sponges for U.S. dollars. We've seen 20% oil sales outside of the petrodollar since 2023, 24. We've seen the rise of the BRICS pay, the M-Bridge, the BRICS unit. These are all symptoms of nations wanting to bypass or go around the marginal line of the U.S. Treasury and the U.S. dollar. Even too big to fail banks like Morgan Stanley, traditionally no fan of gold, have offered an allocation of at least 20% gold from their 60-40 stock bond to a 60-20-20 portfolio in which gold plays a very big role. And I think you can't deny also that people forget that the BIS in the last couple of years made gold a tier one asset alongside of that laughable U.S. Treasury. That's an open symptom, an open signpost that even the BIS, again, of which I'm no fan, is basically saying the quiet part out loud. We now look at gold more than U.S. Treasuries. And, if that wasn't enough, with all these other signals, you've got record-breaking levels of central bank gold stacking since we weaponized the dollar in 2022. It's up 5x as of this year from 2022. And it's still a net gold stacking positive right now. And of course, we've seen a mass exodus of physical gold and silver leaving the New York Common Exchange and the LBMA vaults in London because nations want that physical monetary metal more than a paper claim on it. So again, before we even discuss what's happening now with the hockey puck of gold in the Treasury or where that puck is going, let's just pause to remember the symptoms and the signposts. This is not a gold bug apology or a defense. Look at the de-dollarization. Look at the gold repatriation. Look at the BRICS tilt towards gold for net settling trades. Look at the tier one designation by the BS. Look at the petrodollar, the BIS, I shouldn't call it the BS. Look at the COMEX exodus. Look at Morgan Stanley's confessions. So these are all symptoms of where we've been just in the last 4 years with this gold moving towards and away from the U.S. Treasury. But for where that hockey puck lies today for the U.S. gold and for the U.S. Treasury, or for gold and U.S. Treasury, and as importantly, the direction of that puck, we just have to look again at those rising U.S. Treasury yields. I mean, the 10-year in the U.S. is up 75 basis points this year, and the Fed hasn't raised rates. That's a risk premium the bond market is setting the rates. That's saying we do not trust and we do not like sovereign IOUs in general, and we really don't like the U.S. Treasury, that U.S. IOU in particular. This was, again, a very important signal. It's dispositive evidence of declining demand, which was really just declining trust in the U.S. Treasury at the same time that central banks are net stackers of gold. And as you mentioned, central bank reserves are now much higher in gold than they were than they were 2 years ago. It was 10%, now they're 20%. Their dollar count went from 80% to 56%. Gold share of global FX reserves, as you said, is now greater than U.S. Treasuries. That's not a gold bug argument. That's not a gold bug case. That's just empirical data. And I'll end with this point too, Jess, because the very war or conflict that we find ourselves in, we can't call it a war because we haven't the Senate or the House behind it to declare it. But this very conflict in Iran is about the U.S. dollar and the U.S. Treasury and the fear of its declining interest, its declining hegemony. Remember, Iran gives its oil to China. China is looking to buy energy outside of the U.S. dollar. That is a massive gut punch to the U.S. dollar and therefore indirectly the U.S. Treasury. Because if more and more oil is sold outside of the petrodollar, that is a direct threat to the U.S. dollar, the U.S. Treasury, and to U.S. hegemony. So again, it is no coincidence that we've had regime change wars or freedom-based wars in oil-rich nations like Iraq, like Iran, and certainly like Libya, and even our regime change in Venezuela was based on protecting that U.S. dollar and U.S. Treasury. Why are they so nervous in this deadly serious game? Because demand for U.S. Treasuries is openly being replaced by physical gold. That is a massive, longer-term tailwind for patient investors, of which gold isn't even getting its legs yet. I think the evidence is dispositive rather than just apologetic from the gold camp.
Well, I want to get into expanding global conflict and increasing geopolitical instability in a moment. But first, I'd love to ask you about the gold and silver mining sector. Now, you mentioned earlier that Rick Rule was announcing earlier this year that he sold a large portion of his physical silver. He also stated that he rotated a large portion of that capital into the silver mining sector because he saw such a massive opportunity there. And once again, it's recency bias, people being unable to focus on the long term, but nonetheless, we are seeing both gold and silver appear to be fairly disconnected from the prices of the actual metals themselves. A lot of the big producers in the gold space, Agnico Eagle, Newmont, etc., reported record earnings and have been selling off fairly consistently in the aftermath, perhaps indicating that market participants don't believe the gold price will remain this elevated for this long and that growth profile will not be there. Do you also see this as a disconnect between price and value? And if so, what do you think it will take for the market to catch on?
I think you make really good points. I think, and again, I'm not trying to be condescending. There are many brilliant retail investors. There are many stupid professional investors. So I think it's not just the smart money and the dumb money, but when gold takes a major 20% or greater dip in such a short period of time, people just think, well, the gold trade is over. The innocents just get out. And with that, the baby goes out with the bathwater and the mining side as well. And I think it's an important disconnect and an important misunderstanding we should clarify. Again, I have to be clear. I am not a mining expert. I am a very boring monetary metal thinker. Von Greyer's is a gold company that sees gold as a wealth preservation asset. It's life insurance play on openly dying fiat money. The mining experts that I know and that I trust, the Pierre Lassans, the Frank Justras, the Rick Rules, are far more eloquent in this space than I am. Nevertheless, I know enough to be somewhat dangerous or helpful in trying to look at the bigger picture on the miners, the explorers, and the royalty companies. In the gold equities and silver equities do have an impressive amount of leverage built in. Typically, if gold is up 10%, then miners are up 30%. So on the surface, it's obvious. When the cost of production at a place like, Agnico Eagle is 100 or 1,400, and say gold's at 4,400, it's an obvious profit when the spot price is significantly higher than the cost of production. And so in those kind of mining companies, it's a fat pitch. You look for insider ownership, or in cases like wheat and precious metals, you look for political ownership if Trump is buying. But I mean, it is a fat pitch when the cost of production is so much lower than the spot price. The spread is a fantastic opportunity that I think many are missing because they're looking at, as you said at the beginning, tweets, day-to-day thoughts, clickbait to keep things moving. They're missing the bigger picture. They're missing the forest through the trees. It's the same thing with royalty companies. You know, they finance the miners and get royalty for their metals. There's some incredible value in some of these companies when they're a little bit oversold. Like, I don't know if I'm allowed to say this. I'm not a pundit for it, but like Franco-Nevada, these are opportunities in the royalty space. But I think to answer your question beyond just the paranoia and the schizophrenia and the Twitter cycles and the clickbaiting that goes on in this space and the pundit fear selling and even the pundit apologists, which some could claim that we are. I think my experience from Wall Street, and that's going back decades, but I still see it today, that the generalists on the street don't necessarily push the miners because they often don't trust the management or the leverage or the consistency. And we've seen this year after year, certainly recently, where some of these miners had the sector had the highest free cash flow, but the lowest performing sector on the market. And again, I think it is because the generalists and some of the sell-siders sell this notion that you can't trust these mining companies. As Mark Twain said, give me a miner, it's a hole in the ground with a liar standing in front of it. And, you know, again, that means you have to find the information and the ownership and in the structure and the debt structure and the things that Rick Rule and Justra and Lassonde look at and follow that and do your own homework. But stepping back, it is a very, very obvious fat pitch longer term for the right miners, the right royalty companies, the right exploration companies. Because again, just because we hit all-time highs at the end of last year, beginning of this year, doesn't mean that gold's not going to go significantly higher from here, which means generational wealth can be made in the equity side of the play. It's just not the space that we at Von Greyers or myself individually opine to with any kind of professional detail or specific opportunities. But there's obviously some that I've named, but there's many more to choose from. Do your own homework. But for those looking for a little more juice out of the secular gold bull market, it's a fat pitch again. But again, I look at gold much more boringly, much more conservatively, much more traditionally as trying to preserve wealth, not trying to necessarily generate more wealth. Folks like Rick Rule have both of those mentalities, but it's in his DNA to get out high, find a new value, go low, and then ride it. And Rick Rule, I know quite well from many conversations, is very patient. He can wait years before he gets a signal. I think many investors, whether it's risk assets or mining stocks or even precious metals, their biggest problem is they don't know when to exit a trade. Entries and exits are very hard. The exit can be the hardest thing. With physical gold as a insurance policy against openly dying fiat currencies, I don't have to look at an exit for gold. I just know it holds its value longer. When I need liquidity, I convert it to a Swiss franc or euro or a dollar, and I spend in fiat. I save in the precious metal. Again, that goes back to Thomas Gresham. This is what smart family offices, smart investors who understand the sophisticated reasons behind gold ownership have always done for centuries. They certainly do it in Switzerland. I think more Americans than others are catching on to this as the dollar melts before them, or as the euro melts before them, or even the Swiss franc relative to these metals.
Some great thoughts. I want to shift over to the rising geopolitical instability that continues to dominate headlines. The war in Iran, we're seeing on again, off again peace talks. I think the latest was Trump said Israel and Iran are going to agree to a ceasefire pending stupidity or ignorance. I think he wrote something like that. So I think we can just assume it's not going to happen at this point. The Russia-Ukraine conflict also appears to be escalating. A major attack by Ukraine on St. Petersburg while an economic forum was going on in that city, along with trade wars brewing, authoritarianism spreading among Western governments, and more, putting stacking physical gold and silver to the side. Are there any other ways you think people should be preparing themselves from an investment perspective or otherwise for continued chaos ahead?
Yeah, it's important to put just gold and silver aside sometimes because it looks like we're not looking at the broader world. I'm not going to give my opinions publicly on what I think of this conflict. I already kind of hinted in Iran or what's going to happen in the Ukraine, or what's really motivating this war, who's really doing it, and what I think Iran's real play is to let it drag as long as possible to bleed out the bid on the U.S. Treasury. But I'm no expert. Any pint at any pub is going to be different opinions. Mine's not going to be more helpful. On the economic side, what can we do in the backdrop of this madness, in this backdrop of debt and a war in a time of debt, and a currency crisis and a bond crisis in a time of a conflict? I think we have to step back and just look at the big theme of inflation first. We have to understand it. We either buy into it or we don't. There's the inflation-deflation debate. It's not really a debate. They're cyclical. The inflation endgame to me is quite obvious, but I won't go into a whole reason for that. But once you look at inflation as an investor and you accept the debasement trade as more than a meme, and you look at the purchasing power of currencies, and you look at the invisible theft of grotesquely misreported inflation, then you have to invest accordingly. So we don't need to time a commodity super cycle. We just need to see its inevitability and invest, accordingly. And this is not just a broad defense of commodities. It's just an honest appraisal, in my opinion, of the open decline of fiat currencies. So if you're still on the fence of inflation, I've said and I've written for many years, the first thing is, look, the CPI scale that measures inflation is the greatest lie since big tobacco or safe and effective or the lone shooter in the Texas Book Depository. It's simply misreported. Everyone from Larry Summers to the shadow stats knows this. But even if you look at the official numbers on inflation, CPI, it's the cost of consumer goods at 3.8, and PPI, which is the cost of making things, at 6%. Even the official numbers are pretty alarming, but they're completely dishonest. Since May of this year, as this conflict drags on, fertilizer's over 20%, diesel's up over 50%, gasoline over 50%. Here, European national gas almost 55%, heating oil almost 60%, jet fuel up 58 or 60%, and WTI crude up over 60%. So this is bad. But if oil is greater than 100 and all these other costs are at rising high double-digit numbers, why isn't the U.S. CPI and PPI much higher? And again, my claim is, and I'll stay it for as long as I can breathe, the CPI scale is bogus. And then if you have the Warsh will save us, he won't. His plan, his regime change is inflationary. It's not deflationary. He's not going to fight inflation. He's going to let it run. And then he's going to lie about inflation, which is exactly what Powell and Yellen and Bernanke did. He calls it trimmed mean PCE, which just strips away the extreme costs. It's like I said, if you have a witch and you take away the warts, even a wish can be pretty. And if I were an attorney and I could control the evidence on my side and the other side, I could win every case. And this is what we're doing. We're going to run negative real rates. But it goes back to what assets you can look at besides gold and silver. Again, since 1971, the US dollar versus broader commodities is falling massively. It's fallen 96% against oil. It's fallen 90% against copper, almost 80% against wheat. These are just examples. What I'm saying is wheat, copper, oil, energy, they haven't gotten more expensive. It's the currency needed to buy it has gotten that much weaker and falling purchasing power. So even if we have a recession, which is deflationary, that can create demand pull down and hence price disruptions in hard assets. But the overall broad direction for longer term thinking, patient investing, is moving from growth equities toward hard assets and other commodities in general. Now, in terms of specific things, I think what people want to hear, what I talk about with family offices, what I talk about with my own advisors and my own kind of circle, in an inflationary environment, which to me is undeniable, the evidence is literally flashing in our faces. In an inflationary environment, what assets are important? And of course, beyond gold and silver, well, certainly agricultural farmland, dirt, certain types of real estate, apartment buildings, rental properties, not commercial real estate, not REITs, but this is the dirt. This is the stuff that is going to have value in an inflationary environment. Other things like cattle, energy, these are obvious plays if you're longer term thinking in an inflationary environment and your aim isn't to get rich quick like you could in NVIDIA or SpaceX or some other AI stock. Nothing against speculation, be very nervous about it right now, but there are those who are going to do that. But if you're looking to preserve and stay sane, these are obvious signals in those asset classes. In the equity markets, growth and tech will certainly have a real problem if these markets mean revert. They're overvalued by every metric. But again, the stupid can go on longer until the mechanization kicks in. But I think even in the equity side, you can certainly allocate more to consumer staples or healthcare sectors. I think the most important advice right now, and it sounds kind of Pollyannish, is patience is a skill set too. I always joke, growing in the Midwest, if you're going to go duck hunting, you don't row out in a boat with a 12 gauge and just point at the sky and start shooting. You actually have to wait for the ducks. You have to wait for the opportunity. I think a lot of people are just shooting blindly at growth or tech or AI. And some will be winners, many will be losers. But as a value investor, even in an inflationary backdrop, you've got to pick the sectors and the asset classes that are going to reward and protect you. That requires patience. That requires Berkshire Hathaway-like patience to get out of a way of a market you can't understand. Look for buy signals in assets that are going to survive through an inflationary world. We are in an inflationary world. It's being lied to you. It's being misreported to you. You're literally being robbed at a compounding rate of 10% minimum a year on the money you have in a savings account or RIA. And even in the appreciation in your 401k, it's being eaten away by this inflation. So you've got to pivot towards an anti-inflationary assets. I personally don't think Bitcoin's one of them. That's a rabbit hole we can't go into. But again, be patient, use common sense. Again, I think sometimes that's the hardest strategy of all. It sounds so simplistic. Warren Buffett says, invest in yourselves, in your own businesses in an inflationary environment. There's some sound advice to that. But I also think wait for the duck before you pull the trigger on that 12 gauge. And that's the same thing with your investable assets. And if you want to chase tops in a market that's overvalued by every metric, be careful. It can work if the Fed decides to effectively monetize this S&P forever, nationalize the market. But even as those markets rip up and you get higher returns, you're going to be measuring those in increasingly debased dollars or euros or francs, et cetera. It's just understanding that kind of running uphill in roller skates reality from the invisible tax, the open theft of debasement and inflation, which is robbing everyone as we speak right now.
Some amazing thoughts shared today, Matthew. Thank you so much. Tell us about Von Greyer's and the work you do there.
Yeah, again, we're very conservative, very boring, and very essential right now because, again, we look gold and silver. There's many things you can look at it for speculation and mining, et cetera, but we look at it simply as an allocation to protect against the debasement of paper money. And we've been doing that for almost 3 decades now. And we're based out of Zurich. We have the safest, largest vault in the world in Switzerland. We have another vault in Singapore. Our whole model is simply make an allocation, as the Swiss have done for centuries, to protect against these historical fourth turning points, which we're in the middle of right now, of this currency debasement, to protect against the banking risk and, of course, the geopolitical risk. We think the jurisdiction of Switzerland is by far relatively stronger than others. We think you have to own this gold outside of the banking system. It has to be physical, allocated, segregated in your name. Our minimums are very high. It's not for everyone to be a client, but our commitment, certainly my personal commitment, I know it's true of Egon for decades. Not everyone can be a client at Von Greyer's, but we want to evangelically spread the news that you should look at gold in particular in these type of cycles we're in. It's been a long cycle. We're still in the very beginning of it, but you have to understand gold is a very necessary allocation in a period like we're in. And we just store gold and then we provide liquidity for it when needed, and we keep it in the safest vault in the best jurisdiction in the world. But our website, vongreyers.gold or vg.gold, is an open resource to see all kinds of interviews, read lots of articles, and really beyond just making the case for why you need to own gold, it's how you should own it. And one thing we say very, very fervently, we're not alone. Don't own it in an ETF and don't store it in a commercial bank. You need to have a real claim, not a paper claim on these metals. They're too manipulated in the paper markets, like everything is. And so it's an education. You don't have to be a client to get educated. And obviously, if you're looking to be a client, you can go to the website and find us there. But we're committed to this notion. We have been. It's based on conviction. We could all be selling bonds, I joke, for Goldman Sachs, but we're all former bankers, and we believe in this asset class sincerely.
Excellent. Well, I'm going to put a link below to Von Greyer's. I would encourage everybody to check it out, even if you're not going to become a client. There's so much great work there. Matthew, you write some great articles, so it's worth it alone for the educational pieces. Thank you so much once again for coming on the show.
It was my pleasure, as always. I'm glad to be here, buddy.
Thank you for joining us today. This episode is brought to you by ARC Silver Gold Osmium. They have some great prices on gold and silver bullion products. They are on your screen right now. Reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com. And make sure to tell him that Commodity Culture sent you, and sign up for the very first Commodity Culture Live Boot Camp, June 27th at 1 p.m. Eastern. I'm going to be opening my portfolio A to Z, showing you what I own, why I own it, and describing my own framework for viewing the commodities space. Join.jesseday.ca. The link is in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.